So a lot of people have been asking me how I go about picking dividend stocks for my portfolio. Like, what exactly do I look for when deciding which stocks and funds I'm going to invest in? It's a pretty common question I get because my style of investing is pretty different compared to other people here on YouTube. A lot of dividend channels like to focus on lower yielding stocks like Johnson & Johnson that offer dividend growth over a long period of time, whereas I only invest in what a lot of people would consider to be much higher yielding dividend stocks. So today I want to go over my investing criteria and basically explain how I go about picking securities. But I want to stress to everyone that these are my own personal opinions and preferences. This is how I personally choose to invest, and my objective for this video is not to try to convince you that my way of investing is the best way. I'm also not going to try to convince you that you should invest this way for yourself, because my method of investing is riskier than other investing strategies, such as choosing to just put all of your money into a dividend or a growth index fund. All of this is just how I personally choose to invest, and you can choose to adopt some of these rules and standards for yourself, or you can modify them to be less risky. One comment I see on a regular basis is people asking, what if I put my money into a growth index fund and then start investing in dividend stocks and ETFs when I'm older and closer to retirement? And my response has always been the exact same, which is that's a great investing strategy. If you want to do that and then switch over to dividend and income holdings in 10 or 20 years, then that's completely fine. But that's just not my personal preference when it comes to investing. I found that I'm way more motivated to save and invest my money knowing that I'm collecting 4, 6, 8, and even 10% or more in dividend yields. So it all comes down to personal preference. With that being said, the first rule that I follow when it comes to dividend and income investing is that I do not invest in securities that offer me a dividend yield of less than 4%. That's been my absolute cutoff point for a number of years now, with one exception. The only time I'm willing to make an exception to this rule in which I do invest in something that yields less than 4% is when I buy shares of SCHD, which is the Charles Schwab US Dividend Equity ETF. This is a dividend growth ETF that typically yields around 3 to 3.5% on average that helps ensure that my dividend portfolio still provides me with growth to accommodate for rising inflation throughout the years. It's important that everyone dedicates at least some of their portfolio towards growth no matter what stage of life you're in, and the amount that you dedicate to growth all depends on your own personal preference. And you have two different methods of doing this. You can either choose to invest in holdings that have experienced rising share prices and dividend distributions over the years, or you can choose to invest in higher yielding securities and then reinvest all of your dividends to create a snowball effect. Most people tend to do both up until they retire. If you're younger, you'll want to dedicate more of your portfolio to things that'll provide you with growth, and if you're older, you can dedicate much less towards growth and more into holdings that prioritize income. This leads into my second rule of dividend investing that I always follow, which is if a dividend stock offers a yield of less than 5%, then it must meet one of the two requirements. First, the stock must offer a history of dividend increases. I don't have a set rule like it has to grow its dividend every single year, but typically I'd say that it has to have a history of growing it at least every few years. If the stock can do that, then that's considered good enough by my standards. Secondly, if the stock does not offer a history of providing dividend increases and yields less than 5%, then the stock must pay dividends on a monthly basis. I personally prefer receiving dividends monthly over quarterly, so if a stock offers a yield of less than 5% but it does pay me monthly, then again, that's good enough in my book. Don't get me wrong, I definitely won't overlook quarterly paying dividend stocks, but I think we can all agree that seeing monthly dividends being deposited into our accounts and being compounded through reinvesting is a whole lot more satisfying. I see people leave comments on my videos saying that they only invest in monthly dividend paying stocks, but I personally don't think that this is a good idea to limit yourself to only monthly paying stocks. There's plenty of great dividend stocks out there that don't pay monthly that I think people should consider. There's a good amount of equity REITs and closed-end funds that pay monthly, but there's really not a whole lot of BDCs, M-REITs, consumer staples, and MLPs that offer this. This is a pretty good transition into my third rule, which is I don't invest in any stock or ETF that pays annual or semi-annual dividends. If you're trying to live off dividends, then it's not a good idea to invest in things that only pay you once or twice a year unless you happen to have a lot of other holdings in your portfolio that you've built up to provide you with that more consistent income. Fortunately, there aren't a whole lot of stocks that pay annually or semi-annually. I know there's a few mineral stocks that tend to pay on an annual basis, but it's why I personally never invested in Disney stock, which was a pretty popular dividend stock back when the company used to pay dividends. Now, in terms of what I like to invest in, I created this chart that basically illustrates what exactly my favorite dividend investments are. Again, this is completely my own preference, and most people wouldn't arrange their preferences exactly the same way that I have them here. But on the left, you have the investments that I tend to like and invest the most in, and then on the right, you have the investments I like a lot less and hold less of. My rankings can change, so this isn't set in stone, and just because ETNs and master limited partnerships are all the way on the right doesn't mean that I don't invest in them. I just give these types of investments the least amount of my attention. Although as of the making of this video, I currently don't invest in any master limited partnerships. But equity REITs are definitely my favorite type of investment. They typically offer lower yields than basically everything else on this chart, but there's a lot of REITs out there that have a great track record of being able to deliver strong, dependable dividends. Plus, they're backed by real estate, which is a physical asset, unlike business development companies and mortgage REITs, for example, which are backed by debt and mortgages. Business development companies are my second favorite type of holding. They pretty much always offer much higher dividend yields than equity REITs, usually around 7 to 9%, but they're more susceptible to having their dividends reduced during rough economic times. For example, Ares Capital, which has been a very well-managed BDC that's my favorite, had to reduce their dividends during the financial crisis back in 2008. All the way towards the other end of this chart, we have closed-end funds, exchange-traded notes, and master limited partnerships. Closed-end funds, or CEFs, often pay monthly dividends and offer much higher yields, typically over 8% and even as high as 13%. But there's a good number of CEFs out there that use a lot of leverage, which can make them much riskier. They also charge much higher expense ratios than your typical ETF, plus most don't offer any potential dividend growth. And then you've got exchange-traded notes, which are extremely high yielding, usually over 20% or more, but they're the riskiest type of security on this list. The reason they're so risky is because they can be delisted at any time the issuing firm wants to, and some investors have lost everything on these in the past. This makes them a much more speculative kind of investment rather than a long-term buy and hold investment. Finally, at the end, we have master limited partnerships that do offer very high yields but come with complicated tax situations. You might be required to file multiple tax returns for different states depending on the MLP, and most of them are in the energy sector, which is something that I typically don't invest in. This is because just like with royalty trusts, they tend to be pretty volatile. When energy prices are soaring, then these can be pretty profitable investments, but when they start coming back down, then their share prices tend to fall along with energy prices. So now that I've gone over what my general rules are and what types of investments I like to target, I'll now go through my process of actually picking a security. When I first come across an investment, one of the first things that I do is look at the performance history of a stock. I know that past performance doesn't guarantee future performance, but I'm usually not the kind of person that likes to try to catch a falling knife. If a stock has a long history of steady price and dividend declines, I typically don't like to throw my money into it, betting that they'll be able to turn things around. There's a couple exceptions to this, but I like to invest in companies that are strong and have good track records in terms of dividend distributions. In terms of share price, I don't want to see a sizable ongoing decline in share price since the stock had their IPO. It kind of goes on a case-by-case basis, and I don't have a set rule for this, like it can't be down more than 30% since their IPO, but looking at past share price performance, I can tell right away when a company has been very poorly managed. Oxford Lane Capital is a really good example of this. It offers a great dividend yield, and the share price continues to fall dramatically. It is possible that this company could recover and see their share price surge back to its IPO price someday, but I'm not interested in trying to make that bet. At the same time, I'm also completely okay with a stock that hasn't seen much movement in terms of their share price since their IPO, but still offers a great dividend yield. PennantPark Floating Rate Capital is one company that I like, and you can see that there hasn't been much action in their share price whatsoever, but it offers a great dividend distribution yield that pays monthly since their IPO. One of the few exceptions to this rule that I have is for RC Capital, which is a stock that I have a very small investment in that's seen a sizable decline in share price. But within the last 5 years, I think this company has been turning things around given that they've been expanding their business services. So just comparing the share price to 5 years ago, you'll see that it's only down about 4% while offering a 12% dividend yield. This is a stock that I have no issue in considering, and like I mentioned, this is one of the smallest holdings in my portfolio. One more historical trend that I look at for every dividend stock or holding is their dividend distribution history. Because if a stock has a history of cutting their dividend over and over and over again, that's a huge red flag to me that says either the business is failing, or management isn't doing a good job, or the sector the company operates in has been going through a long, difficult season. Typically, my rule for past dividend distributions is I don't want to see more than 3 dividend cuts within the last 10 years. I do take the pandemic into consideration though, as there are a lot of companies that had to reduce or even suspend their dividend during COVID. Another example would be Sachem Capital, which is another very small holding that I have that had a history of growing their dividend, and then you can see they paid a special dividend back in 2018, and then during the worst of the pandemic, they actually missed a dividend payment. But just like with RC Capital, they were able to restore it next quarter, and they even grew it just recently. This is another good example that I'm personally okay with. So after performing all of these checks, if a security is able to pass all of these, that's when I'll start looking at the financials, SEC documents, investor presentations, and etc. for a particular holding. And this varies greatly depending on what exactly I'm looking at. Obviously, I wouldn't analyze an equity REIT in the exact same way I'd analyze a master limited partnership or an exchange-traded note. There's obviously way too many different metrics and reports to cover, and there's enough information to cover that could be a video for each investment type. But the bottom line is, in order for me to consider an investment, it has to pass all of these tests. There might be an unusual situation here and there, like one stock might have one additional dividend cut than I prefer, or maybe it yields 3.9% as opposed to 4%, but what I've just gone through basically lays out everything that I look at before taking a deeper dive into an investment. Like I said, these are just my personal criterias, which are more aggressive than most people, and I'm okay with that. If you choose to adopt any of these for yourself, then that's fine. Just be sure you're aware of the risks and feel free to change them based upon your own level of risk tolerance. And that's going to conclude today's video. Thank you all so much for watching. I really do appreciate it. If you found this video informative, please consider giving it a thumbs up below and also subscribe to the channel if you want to see more high yield dividend investing strategy videos. It would just let me know that there's enough people out there who want this kind of content, and I'll continue to provide you all with that content. Alright, thanks again guys so much for watching, and until next time, take care.